Imagine this for a second. You've done everything the way you were supposed to for 3 decades straight. You never skipped a 401k contribution. You held on through every terrifying market dip. You didn't cave and sell when everything looked like it was falling apart. Now, you're somewhere in your late 50s or early 60s, and when you look at your portfolio, it actually looks strong. That number on the screen is real money. It took 30 years to build, and yet something still feels off. Here's the part nobody warns you about. It isn't the crashes that wreck retirement savings. It isn't the corrections, the bad years, or the scary headlines about inflation and recession. Those are loud. Everybody talks about those. What actually drains a retirement account, quietly, slowly, over years, is usually something that's already sitting inside the portfolio. It's been there the whole time, looking completely harmless. So let's walk through 6 assets. Things that seem totally normal. Things most financial advisors never think to flag. None of them show up on any warning list, and yet they slowly hollow out retirement savings from the inside. A few of these might feel a little too familiar. Let's start with the one that's going to make some people want to click away immediately: the family home. I want to be clear about something here. Owning a home isn't the problem. The problem is treating your house as your main retirement asset, as if it were your actual plan. That's one of the quietest, most damaging financial habits out there, and an enormous number of Americans are doing precisely that. Here's how it usually plays out. Someone spends decades chipping away at their mortgage. The equity keeps building. The house keeps appreciating, especially if they bought at the right time and rode out a couple of boom cycles. Then one day, maybe in their late 50s, they run the numbers and realize the house is worth something like $600,000. Suddenly, they feel wealthy. They feel like retirement is basically handled. But here's the uncomfortable truth. A house doesn't pay you anything. It generates zero income unless you sell it, rent it out, or take on something like a reverse mortgage, which brings its own pile of complications and costs. Most people have no plans to sell the home where they raised their kids. Most people don't want to become landlords. And most people are wary of reverse mortgages, for reasons that are both financial and emotional. So what you're left with is a massive chunk of wealth trapped inside something you can't easily touch, and on top of that, it costs money every single month just to keep it running. Property taxes, insurance, repairs, utilities. That money has to come from somewhere. The real risk isn't owning property. The real risk is mixing up home equity with actual retirement income. Those are two completely different things. One is a figure on paper. The other is cash that lands in your pocket every month. In retirement, that difference matters more than almost anything else. So here's the useful exercise. Actually map out what your retirement income looks like if you take the home equity out of the equation entirely. What does the picture look like if that $600,000 just stays locked away? If the answer makes you uneasy, better to know that now than to find out at 67. Next up is whole life insurance, a product that's practically achieved cult status in certain financial circles. People pitch it with the fervor of true believers, and once you dig into the mechanics, you can understand the appeal. There are situations where it genuinely makes sense, but for most people using it as a retirement savings tool, it's slowly, steadily chipping away at their future. The pitch usually sounds something like this. You pay in premiums. The policy accumulates cash value over time. That value grows tax-deferred. You can borrow against it later in life, and there's a death benefit for your family on top of it all. On paper, it sounds elegant, like a savings account and a life insurance policy rolled into one. Except the costs baked into these policies are enormous. Internal expense charges, mortality costs, administrative fees, surrender penalties if you try to leave early. They stack on top of one another in ways that are hard to untangle even for people who are financially savvy. A dollar invested in a whole life policy simply does far less work than a dollar sitting in a low-cost index fund inside a Roth IRA. Stretch that gap out across 30 years, and it isn't a small difference. It's enormous. There's also an emotional trap built into this asset that makes it particularly damaging. You've been paying into the policy for years. There's cash value sitting there. Walking away feels like throwing money out the window. That sunk cost feeling is exactly what keeps people locked into policies that quietly cost them far more than they realize, year after year, well into their 50s and 60s. If you're holding a whole life policy, don't panic and don't make a snap decision. Instead, get an independent review from a fee-only advisor, someone who isn't earning commissions from insurance sales, and find out exactly what that policy is actually returning once every cost is stripped away. The results are often eye-opening. This next one is going to hit close to home for a lot of people because high-fee, actively managed mutual funds are everywhere. They're sitting inside 401k plans. They're in IRAs. They're constantly marketed as the smart, sophisticated choice. The story is seductive. A team of skilled analysts combing through data, making sharp calls, trying to beat the market. You're paying for expertise. You're paying for that extra edge. Except decades of research, genuinely overwhelming, exhaustive research, show that most actively managed funds fail to beat their benchmark index over long stretches of time. Not some of them, most of them. And the small number that do outperform in a given year or decade have a terrible track record of keeping that edge going forward. Past performance really doesn't predict what comes next, no matter what the fine print might suggest otherwise. But here's what makes this especially damaging as a retirement holding: the fees. An annual expense ratio of 1.2% sounds almost harmless. It's barely more than 1%. But compounded across 20 or 30 years, that means a meaningful chunk of your total portfolio growth gets handed straight to the fund company. Not because the fund earned it through outperformance, but often despite failing to deliver any outperformance at all. Run the actual math. Take $1 million invested at a 7% annual return with a rock-bottom 0.05% expense ratio and compare it to the same $1 million earning that same 7%, but with a 1.2% expense ratio instead. Over 20 years, the gap is roughly $250,000, $250,000 gone. Not because of a crash, not because of a bad year, just fees, quietly chipping away year after year. If you're within 10 or 15 years of retirement and you haven't checked the expense ratios sitting inside your portfolio, that might be the highest value half hour you spend all year. Log in, look at the actual numbers, compare them against low-cost index alternatives, and then make an informed call. Concentrated single-stock positions are fascinating because they almost always come with a great story attached. Maybe the shares came from an employer. Maybe someone got in early on a company that turned into something huge. The position feels personal, not just financial. There's pride wrapped up in it, sometimes even identity, and that's exactly what makes it dangerous. There's a version of this story with a happy ending. Someone holds a big stake in a company that keeps climbing, sells at just the right moment, and retires comfortably. Those stories get told constantly because they're satisfying, and they reinforce the idea that conviction and concentration pay off. What doesn't get talked about nearly as much, because it's a far less pleasant story, are the people who had $300,000 of their retirement savings tied up in a single company's stock, and then that company hit a rough patch, or a scandal, or just quietly declined over 10 years. By the time they were ready to retire, that position had lost 60, 70, even 80% of its value. This happens all the time. It happened with Enron, it happened with GE, it happens with smaller companies nobody ever writes long articles about, to ordinary people every single year. Most financial planners lean on a simple rule of thumb. No single stock should make up more than 5 to 10% of your total investable portfolio. And even that upper limit makes plenty of advisors uneasy. As retirement gets closer, the imbalance only gets worse. You have more money at stake, less time to recover if things go wrong, and the companies you're most concentrated in tend to be the ones you feel the most confident about, which is its own kind of trap. If you're sitting on a concentrated position with a large unrealized gain, yes, there are tax consequences to unwinding it. Yes, it takes planning. But there are approaches, gradual selling spread across multiple tax years, charitable giving vehicles, exchange funds that can help you manage the tax hit without staying fully exposed to single company risk right up until retirement. Annuities occupy a strange corner of retirement planning. Some versions are simple, low-cost, income-focused products that serve a real purpose. A plain, straightforward, immediate annuity that turns a lump sum into guaranteed monthly income for life can absolutely make sense in the right situation. But the annuities most aggressively sold to people nearing retirement usually aren't those simple products. They're variable or indexed annuities loaded with riders, extra features, and guarantees, wrapped inside prospectuses that are genuinely hard to read. They often come with surrender periods, sometimes 7 years, sometimes 10, during which you can't touch your own money without a penalty that can run as high as 10%. Picture someone buying one of these at 58, when retirement feels close and the promise of guaranteed income sounds appealing. They may not fully grasp that they've just locked up a large chunk of their savings in a product they can't access without a penalty until they're nearly 70, or that the internal costs, mortality and expense charges, administrative fees, rider fees, might add up to 2.5 or even 3% a year. That's a massive drag on a product that's supposed to be securing your retirement. Think about it this way. If the investments inside the annuity are earning 7% and you're handing over 3% in fees, you're really only earning 4%, and you can't walk away without paying a penalty for years. It's a slow leak in a container that was supposed to be holding your savings. Watch for these warning signs: surrender periods longer than 5 years, total annual fees above 1.5%, a product being sold by someone earning a large upfront commission, and so much complexity that you can't explain what you actually own. If you can't describe the product in plain language to someone else, that tells you something important. Real estate investing genuinely works. That's not up for debate. Plenty of people have built serious wealth through rental properties, and it remains one of the most powerful wealth-building tools available to someone with the capital, the temperament, and, this part matters enormously, the time. The version that quietly wrecks retirement portfolios looks a little different. It's the rental property bought during a different chapter of life, when there was more bandwidth, when the mortgage was smaller, when handling a vacancy or a repair didn't feel like it threatened a fixed monthly budget. It made sense back then. It was a smart move at the time. But real estate is an active asset. Even with a property manager handling the daily grind, there are still decisions to make, calls to answer, problems to solve. A roof that needs replacing, a tenant who stops paying, a vacancy that drags on 2 months longer than expected. During the years when you're still building wealth, those headaches are annoying but manageable. In retirement, when your cash flow is fixed, your tolerance for stress is lower, and your time to recover is shrinking, those same problems feel completely different. Then there's the liquidity issue. Like the family home, real estate is illiquid in a way that can really hurt you. If the market shifts, if you suddenly need cash, if the property stops generating the income it used to, you can't just sell off a slice of it. You have to sell the whole thing at whatever price the market happens to be offering at that exact moment, which may not line up with your needs at all. None of this means you should dump your rental properties the second you turn 60. It means building an honest picture. What does the cash flow actually look like once you factor in taxes, property management, and maintenance reserves? Is it truly earning its place in your portfolio? And just as important, is the lifestyle cost worth what you're getting financially? For some people, the answer really is yes. For others, it's quietly dragging down both their finances and their peace of mind. Here's what connects all 6 of these. None of them are scams. None of them are obviously bad decisions. Every single one made sense in some context at some point in time. The family home built real equity. The whole life policy felt like security. The actively managed fund seemed like the sophisticated choice. The single stock position had a great story behind it. The annuity promised certainty. The rental property generated income. The issue isn't that these assets are inherently flawed. The issue is that they're quietly expensive, or quietly hard to access, or quietly out of step with what retirement actually requires. That mismatch can build up over years without anyone noticing because nothing ever looks obviously broken. Retirement rarely gets wrecked by one big mistake. It gets wrecked by small, persistent ones. A 1% fee doesn't feel like much in year 1. A concentrated position doesn't feel risky while it's still climbing, and a liquid asset doesn't feel like a problem until the moment you actually need cash. And then, all at once, years of quiet erosion become impossible to ignore, and there isn't much time left to fix it. The most valuable thing you can do with any of this, whether it's one of these 6 or all of them, is simply take an honest look. Go through what you actually own and what it's really costing you, not what the brochure claims, not what the salesperson said, but what the math tells you once you run it yourself, using a low-cost alternative as your benchmark. You've spent a long time building this. It deserves a clear, honest look at whatever might be working against it.